Good day, my name is Ed McFerran and I'm House Counsel for Tax Deferred Exchange Services. We're a qualified intermediary company headquartered out of Tacoma, Western Washington. We provide services throughout the United States. Hopefully today we'll provide you a bit of information in this video regarding primary residences. It's a bit outside of our practice, however, as an attorney I'm accomplished and can talk about the area of primary residence transactions. And they're a bit different because a primary residence has a group of special exceptions. The special exceptions do not require that one provide a tax-deferred exchange, but there's many misunderstandings out there in the marketplace today. Some of our older clients will look back and talk about the $125,000 once-in-a-lifetime exemption, which many years went away, but many people will believe still exists today. Many property owners or homeowners out there will believe that in order to put off the payment of capital gains tax on your home that you have to acquire another property. Well, that's not good law either. That was changed many years ago. Effective 1997, Section 121 of the Internal Revenue Service Code came into existence and provides us today the type of exemption that we've had since 1997, which is changing a bit in 2018. As we do this video, we'll talk a little bit about past history, but we'll also refer to the tax code as it has been signed by the President and as it will come into existence here in 2018. Under the previous rule since 1997, a party who lived in their primary residence could exempt up to $250,000 of gain on the property if they were a single individual, could exempt up to $500,000 of gain, capital gains, on their property if they were a married couple, and they had to live in that primary residence 2 of the previous 5 years. That provided what's called an exemption from the payment of capital gains tax. As a result of that, it's been a very favorable opportunity for parties because they can complete a transaction every 2 years if they have the momentum to move that often. So the key thing that we need to know is that, number one, a party need not do a tax-deferred exchange on their primary residence. Number two, this exemption that's available, we need to know, is changing a bit, and it's changing from 2 out of the 5 years to 4 out of the 8 years that a party lives in the property. So the time period of remaining in the property is going to double in length based upon the new tax code coming into existence at the beginning of 2018. As a result, this type of property is exempt from the tax-deferred exchange, but may be included in a tax-deferred exchange in an area of practice that we call blended property. If you have a primary residence that has attached to it other property that could be used for investment purposes, I'd highly suggest that you contact our office regarding that and also ask one of our staff or take a look at our YouTube video to take a look at what we call blended property, which could be very helpful for you in that endeavor. Again, this is a general piece of information on primary residences. It doesn't replace the competent counsel of one of our attorneys or your tax preparer, and hopefully it will be of help and assistance to you in completing a potential tax-deferred exchange. Good day.